everyone.
Hello.
Welcome back to our YouTube channel.
Yeah, welcome.
Yeah, so as promised, we promised that we're gonna bring a lit video this week. And here we are delivering. Gotta get people what they want. Or is it what they need? It's what they need.
It's what they need.
Yeah, so as you can see, guys, today we're gonna talk about savings and the options that are there for investing your savings. Now we have to put this across. We're not gurus, we're not experts, but we are people who have had savings and therefore have done some research and considered different kinds of investment options. So we're going to be sharing with you guys 4 of the ones that we have thought about. We must say also, this is very important, this is not financial advice. We are not registered with the FSCA. We're just your regular friends who love you, okay? Yeah, so let's get started.
Yeah, so I think one of the things that you can look at in doing your savings, and the first one we're going to speak about, is investing it in business.
Yes,
Yeah.
why not? Right? We should all be entrepreneurs, okay? All of us. Don't make that excuse about how we're not all corporate. Okay, cool, fine, maybe yes, but I do think that while not all of us can be entrepreneurs, there's not enough of us that are meant to be that are actually going the route, right? So yeah, we do think that investing in your own business is a great opportunity to invest your savings.
Yeah, and here's why. So just starting off with thinking about investing your savings into a business, you really need to think about the risk, right? And I can basically say there are 2 things to think about when you're thinking about the risk. One is capital, right? So how much money from your savings you want to put into the business, right? And the other thing is the return of investment. So how much money every year are you getting from the business compared to what you put in, right? So looking at the return of investment, you need to consider the viability of the business, you know, how well it will do. And that's kind of the risk you need to take to think about. So when you want to invest your savings into a business. And with regards to capital, thinking about, I would say maybe consider not taking all your savings into one business, you know, because obviously you're investing all that money into that risk, you know, so you need to think about that. And yeah, businesses are very nice. Like you're saying, you might not feel like an entrepreneur, but there's a benefit to it, you know. So one of the benefits is that maybe once you've accomplished your payback period, which is the time the business takes to make the money that you put in, right? The money you get afterwards is perpetual interest, you know, it's uncapped. It's based on how your business performs, you know, but the idea that you can make as much money as time allows you, you know, from just a small amount of investment. So that's why businesses are quite good. And the other thing why I think businesses are good is tax. There's a lot of tax incentives for businesses, especially in South Africa, and also a lot of support for businesses. So government incentivizes businesses, obviously, because they help the economy. They help create employment and things like that. I'll give you an example. The Department of Trade and Industry, right, in South Africa, they have got a scheme called the Black Industrialist Scheme, which supports local businesses. Even under this COVID-19 situation, there are some supporting schemes like the COVID-19 Small Businesses Fund, which helps small businesses.
I mean, there is risk to business of losing your capital, some of it or all of it, right? So that's the con of starting a business, and of course there's a lot of work that you have to put in making sure that your business is successful. But guys, living is a risk.
Yes.
Just being alive.
You can lose your
it's
job.
Risky.
Yeah, you know, there's a risk to everything.
Yeah. So I also think that business is a great way of investing your savings. Right. So if you don't want to be an entrepreneur, then which you should. Okay, kidding. So number 2 on our list is investing in equity. So what equity is one of the 4 asset classes. If you know asset classes, this will be your equity, which is shares and bonds, shares and stocks, and bonds, that's another asset class, listed property, and cash or money markets, right? And I love I love easy equities. I'm sure a lot of you have heard of it. So the nice thing about it is that it puts all of these things in one app that gives you accessibility to all of these other things that are out there, right? Right. So the nice thing about equity is if you go in it for the long haul, which should really be the only reason you go in it, is that they have consistently been proven to yield much more results than other investment vehicles, and this is the truth. But if you go for the if you go for the short term, that's where you're gonna get stressed. So this instant gratification that we like to cause you stress if you go with that mentality into shares, because companies there's a lot of fluctuation on the valuation of stocks and shares on companies, right? And many times you're gonna see your money going into the negatives, honey. So if you're in it for the short term, you get stressed. But go do your research, go find out this is a fact. Equities have been found to yield much more interest in the long term than other investment vehicles, right? So you can invest in shares and stocks via ETFs. ETFs are exchange traded funds. They are carefully picked companies or assets and stocks that you can invest in as a form of a group. So what they do, the nice thing about that is that it balances out your risk. When another company goes up, another will go down, platinum goes up, gold goes down, whatever, the risk gets balanced through, right? So that's the nice thing about ETFs. And the nice thing also about ETFs is that you can buy them via the stock exchange by yourself, right? Another way in which you can invest in shares and stocks is via unit trusts. They're pretty much like ETFs. They are units of carefully grouped shares and stocks, right? But these ones you don't manage by yourself. They are managed by asset managers like your Investex, your Ellen Gray's, Old Mutual, Coronation, so you can buy units from their unit trust that they have set up. The nice thing about that is that they do all the work for you, right? So they go out there and they look at what are the most best performing companies or whatever, best performing stocks, what are they, and then they group that and do the investment. All you do is invest in units of those unit trusts, right? So that's the nice thing about unit trusts. These usually they yield better results than your bank returns on like your fixed deposits or savings interest. I don't know if you can even call that investments. Are they investments?
We can say long-term saving vehicles. Maybe.
Yeah, they are saving vehicles, and I think they're a good place to put your money because they have no risk or very low risk while you think about where you want to invest your money.
Yeah.
Right. Yeah. So the pros for unit trusts is that they yield higher results. You do less research, although you should get some form of information. For example, while you don't have control on which shares or stocks your money gets invested in, you do have control over which asset manager you use, right? So there are usually reports that you can find easily on Google about which asset manager or whose unit trust perform better in a particular year, right? Maybe you want to check what happened last year in 2019, go and compare Ellen Gray, go and compare Coronation, go and compare Investec and see. So then you can choose the best performing asset manager to invest your money in the form of unit trusts.
Okay.
Yeah.
It's quite interesting.
Yeah.
Yeah.
So the disadvantage about them is that fact that you don't have control over what shares and stocks they invest in. But generally they perform better than your bank interest rates for your fixed deposits and savings accounts. Yeah. But of course there is risk. As with anything, there is risk in that the volatility of stocks and shares is quite high, so the risk is quite higher than putting your money in a bank or something like that. But like I said, in the long term, in the very long term, we're talking 10 years, and anyway, we are comfortable with property, for example. When it comes to property, we understand that the only time you're going to benefit or profit from it is in 10 or 15 years. So we are comfortable with that. So even with shares and them, going into it with that mentality, you'll see that over the long haul, over that amount of time, about 10, 15 years, you'll make more money in equities than in property. This has been proven. I think I've listened to someone somewhere saying in the past 10 years, the New York Stock Exchange has yielded more profits than the New York property market by almost 50%. This is a fact that you can go, I mean, it's not a fact, it's something I have heard, but if you want to really ascertain yourself whether this is true or not, go and do that research. So the long haul, long term, that's a goal. Yeah, so definitely do look into investing in equity, in shares and stocks via apps like Easy Equities. Sometimes your bank will also have a portfolio for you to be able to invest in shares. But I mean, I think Easy Equities is just a revolutionary, right? So definitely, what's number 3, baby?
Number 3 is looking at saving for retirement. I know a lot of young people don't think about this because
and the earlier you start, the better.
The better, yeah. And the thing about investing your savings towards retirement is because one of the things that it brings out is you save a lot on tax, you know. So if you think about your savings, most of your savings come from your income, and you know income tax is real. You know, even if you earn R1 in South Africa, you pay 18%. So 18 cents is going. No, R1 to 188,000 rand. You pay 18% tax, income tax. And if you earn above that, obviously it starts going up as the income brackets increase. And it goes up to 45% in South Africa. So that's a lot, you know. And you can save on that by investing your savings, basically. I'll look at it more as a long-term saving vehicle, really.
Actually, investing is a long-term game. There's no way there's no other way about it. It's a long-term game.
And basically, you can invest in a pension fund or what they call a provident fund. So I'll give you a practical example. Pension funds are administered by your company, whereas provident funds came about because of unions. And I'll explain a little bit about the difference between the two. Right? So your company will take some money from your income, your gross income, before it's taxed, and put it into the pension fund. So it allows you to avoid paying the income tax. That's what it does. But the taxmen and the tax code come with rules. You know, they allow you to do this, but there's a catch to it. And before I get on to that, I'll explain the difference between pension fund and provident fund. So pension fund, as I say, administered by companies, while as provident fund, it's usually professional bodies and unions. You know, they are more flexible. The thing with pension funds, when you do retire, this is one of the catch, right? When you do retire, you need to invest 2/3 of that money that you've saved on that pension fund according to the taxman's rule, right? And you can only take out 1/3 or cash in 1/3 unless it's less than 50,000 rand. Whereas provident fund, you can take it all out. Yeah? Now, if you, let's say you're working for a company and it doesn't have any pension funds, right? These are called occupational retirement funds, by the way, the pension fund and the provident fund. So if you don't have that, you can look at what they call retirement annuities. So they call these individual retirement funds. And they're quite interesting, right? Because retirement annuity funds, you can get it yourself. You know, you can go to an asset manager like Ellen Gray, for example, or a policy company such as Old Mutual, and you can go to them and you can get this and buy this. It's a product, right? So retirement annuities, they work the same way as provident funds and pension funds, except that you get it yourself. And there are 2 types. There's an investment linked one, right, which is more flexible, and the policy one. So you can get these from asset managers or policy companies, policy insurance companies. And then the interesting thing about this thing is that with the savings, what the taxman allows you to do, right? As I say, like there's a condition to you saving tax. With that 2/3, let's say now you've retired. And by the way, the catch with these as well is that you only cash them in I think between the ages of 55 and 75.
Okay.
So you keep saving into this fund, and when you are 55 or between 55 and 75 and you want to retire, you can cash in, right? But you can't, for pension funds, remember, you can't cash in all of it. 2/3 have to be invested. And the taxman actually just gives you two options. You can either buy what is called a life annuity or a living annuity, which is a product. So basically the difference between the two is that the life annuity, right? When you cash, they'll pay you a certain amount every month, right? And you can't increase that amount. And if you die, they take your money.
That's the disadvantage.
That's the disadvantage, right? Whereas the living annuity, they pay you a certain amount. They pay you a set amount based on, I think it's between 3 to 17% of what you saved in, and also you can, when you pass away, you can leave it to your beneficiaries. So it's quite an interesting, savings, long-term saving. Yeah, and you save on tax.
Yeah, and also the magic of compound interest, right? So that's why the earlier you start, the better, and we must be saving for retirement, really.
Yeah.
Okay, so our last one on the list today is property.
Yes.
Yeah, the long-hailed property. The nice thing about property is the level of risk is quite low, but I'll get into the cons and whether that is actually true about the level of risk. But the nice thing about property is, you're probably set for life when you have property. There's low interest when you are getting a bond to get a property. So if you have savings that can allow you to actually buy a property cash, you're better off if you have savings that allow to buy you property with a huge sum of deposit. So then you're better off, you're looking at a rate of return of maybe 8 years if you bought cash, and many more years if you've got a bond by your interest. But at least you know that after that time lapses, then you have this thing. If you went into it for the profit, you have this thing that gives you rental income until you die. If you live in it, that's another story for another day. But property, yes. But there's an exciting thing that Easy Equities actually just launched. They launched Easy Properties, right? The nice thing about this is you can own property fractionally, right? What I like about it is that you can own property at an amount that you can afford at the moment, at an amount that you are comfortable with at the moment. And it also gives you access to different kinds of property, which you normally as an individual wouldn't have access to, right? So you can have access to industrial property, you can have access to office space property, you can have access to commercial property and residential property. So what they do is just like shares and other things, they just basically pool investors' funds for them to be able to afford a certain property, and then they pay you based on interests or dividends or whatever way in which they get income from that property, right? So that's a nice way. So definitely go check Easy Properties out. If you already have an Easy Equities account, you can just go into your account and activate Easy Properties, and then you're done. Basically just put your money into Easy Equities, and then you invest some of it into Easy Properties, some of it into ETF, some of it into shares, some of it into stock. It's beautiful.
It's a beautiful.
It is. So yeah, guys, that's the way. Remember, the game of investing is for the long haul, and therefore if it's going to be for the long haul, you have to make sure that it aligns with your set goals, right? Don't just invest because people are investing in something. Think about your goals. You must always be aware of what your goal in life is, right? And the investment vehicle that you're going to choose needs to be in line with what you want to eventually achieve with your life. Right? Yeah,
and just on top, if you can look at the general outlook of investing savings, it's either you're you are reducing your taxes on your savings and your saving investment on interest on your savings, or you are increasing the interest. So it's usually those two, and all these
Play around with those
things. Yeah. It's quite interesting.
Definitely. Maybe we should have started with a definition of investments. Investments are things that we put capital in with the hope of getting profit, right? Keep that in mind. So when you play your investment game, remember that definition, remember your goals, remember your objectives, so that you can pick one that suits your lifestyle and your goals.
Yeah, this is powerful.
Definitely. Yeah.
Yeah, make money to make more money.
Yeah, make your money work for you. Okay, guys, it's been good. Hopefully, you are gaining something from the series. It's very exciting for us. We love sharing information. Please share with your friends. Remember to like, remember to subscribe. And thank you to everyone who subscribed already. We really appreciate it.
Yeah, we really appreciate it. And just do comment as well.
Engage with us.
Engage with us.
Let's hear about what your investment options are. If you can teach us something, drop it in the comment section. We're happy to learn. All right.
From us, it's a goodbye.
Bye, guys.